Okay, good afternoon, all traders. Today is April 29th, 2015, and once again, welcome to your Traders Alliance weekly webinar provided by the Inside Technician for all people who have come through the educational system here in an effort to provide you with the continuing education and the clarification of the questions that you have to help you become a more profitable trader. My name is Jeff Kelly, and I'm the Chief Market Strategist for the Inside Technician. Today it's my pleasure to present a setup that occurred between the overnight session and early morning at around 7:30 a.m. to provide a lot of traders, including myself, with a substantial profit opportunity for myself in the form of two different legs, two different trades on a downside move. The presentation is based off of the larger portion of questions that have come in. Can we please provide a real-life trade example walkthrough very similar to what was offered, well, now we're going back almost a year ago for all clients, which what was once the Nightly Market Intelligence Report. So that's exactly what we're going to do, a trade dissection. Now, anytime we're going to trade in real time, we have to understand that first and foremostly, we need to make sure that we're on the right side of the U.S. market in order to trade in the same direction as the overall tide. Right now, according to the daily analysis, better said early this morning, before any real-time trade considerations were taken, was that the U.S. market is due for a sell-off. There's a lot of negative divergences on an end-of-day basis that have officially been established as soon as the overnight session opened and continued into the early morning hours. So the disparity between the current indicator levels on an end-of-day basis and previous indicator levels was such that it provided us with a lot of negative divergences in the form of a real trading opportunity that was soon to take place. No one could have predicted that it would happen today up until the move actually took place, but we were prepared for that, and this is exactly what did happen. When we look in the real-time arena, we want to go with what is the most proven time frame in order to analyze and consider trading any opportunity whatsoever. That becomes the 15-minute charts. You are looking at a 15-minute chart here of ES, the S&P 500 mini futures, with the support levels laid out to the downside that actually become price profit targets. These levels are carefully selected in advance to be able to provide us with a series of levels that can and do allow us to trade a series of moves within an extended down move in real time. Resistance had been established here between here and here, these two different price points at exactly the same level. However, although the prices had been within a channel established between this resistance level and the support level at 21.08 and 75, there was something clearly happening behind the prices that only the indicators could reveal. And in this case, based on this methodology, we have a substantial dump that happens right here, a pump and a dump. The dump was actually larger than the pump that came in here. From that point forward, moving into the hard reg, here, and down here had been substantially lower than where the actual smart money ended the dump at this point. Now, although prices traded up marginally, it could not exceed the previous high area here, once again constructing an official double top. Now look at the divided difference between where the price is here and what the actual indicator is saying based on where the pump ended right down here as compared to the peak as compared to this peak and what the prices were saying here. This is a substantial difference in the strength of the indicator itself. Now the 14-period money flow index is the shorter of the two, separate but similar smart money tracking indicators that we use here at the Inside Technician within this methodology. It's clear to see that the levels themselves are much lower here as compared to the prices, and again here confirming the down move and finally getting through this area here, what was once a floor level within the indicator itself as compared to the actual price level here to be short. Confirmation in the form of the price movement getting through the floor to be short through 2108.75. The levels that are laid out here as they are selected, first and foremost, they are based on the most recent price action right here at 2108.75 on a 15-minute chart. Below that, we have a price point right here based on the lowest price, whether it's an open or close, by this 3-bar pattern, and an established pivot point low right here. Below that, I know we have an incremental level right here, and I know we have the majority of data points right here. That is 1, 2, 3, 4, 5 different data points cut through almost a 50% distance between the open and the close on this bar. So if prices are going to trade down, they need to get through 2108.75 as selected by these prices here, which lays out clearly the bottom side of the channel. They need to get to 2107.50 for an initial target, 2106. Then here, based on this accumulation of data points, these two here, and then 2104.50 is the number, 2102.75 based on these two data points. Below that is 2125, the 50% retracement between the open and the close, and this data point, the union of the two. And then here, for the downside move, if prices move that far, they will be the open of not these two levels, but this bar on the open, because this is where prices will hit first on a downside rally versus here and here. That end number was 2099. Now, no one knew exactly how far the market would sell off today. However, as a professional, we need to be prepared for anything that could happen. And if the overall bias between the end of day analysis and a strong real-time high probability trade setup to the downside is in fact valid, we need to lay out the levels in as far as we can to profit from any one of a number of legs to the downside. Here, the negative divergence is compared to the price action, the eventual cross here between the internal floor level as compared to the price floor level, and the series of targets to the downside provided us with more than enough opportunities to be exactly at the right time, at the right place. Notice how prices originally almost stopped exactly here at 2104 and 50. Look at how they maintained resistance to the upside at 2106, which was initially a price profit target that was hit exactly here by that bar's low. Out on a rally right there. Second move here, another move here, and the low all the way down to 2099. That is no coincidence whatsoever, because prices move in levels, because the smart money uses these levels to calculate in advance well-orchestrated moves, in this case to the downside. Can I get a raise of hands from everyone who clearly understands exactly what I have explained so far? Anyone else? Nicholas, Mark, does everyone understand? Okay, you'll have plenty of time to play this back. For those of you that are running a little bit behind, as this will be uploaded tomorrow to the servers. After reviewing the findings of the MFI and looking for the short opportunity, we move right into the chicken money flow 21 period indicator and look at the substantial difference between how far the dump on the chicken money flow side was as compared to the non-follow through at that time on the prices. And full well knowing that as the indicator itself followed through to bottom out again, that it was just a matter of time before prices should get out of the channel, and the bias was obviously to the downside. Now here's where we are at this point. All we're looking for is the eventual trend line violation to the downside, along with the violation of the price floor level itself right here, once again at 21.08 and 75. That violation came on both fronts, both the prices and the indicator internal level right here on the 15-minute bar that broke the floor level to take the trade to the short side. After that, let's take a look at the MACD indicator, and we can see before the move is taken right here, and this is backing it up Eastern time to the 15-minute bar that closed at 7:15 a.m. Again, 7:15 a.m. Eastern Standard. Floor level once again 21.0875. The trend had already changed, and you were good to be short. Now this is a lagging indicator. It takes a lot for this to fire, people, and to wash away the inherent volatility of a supposed trend or non-trending chart pattern. Requires this indicator to cross, in this case, from above to below, to clearly provide you with an opportunity to know that the trend has officially changed. And this is long before the floor level at 21.0875 is penetrated. So here's an incredible opportunity, an incredible advanced warning mechanism that is in place to provide you with, in this case, an advanced notice that the trend has already changed, and all we're waiting for is the substantial volume to come in at or near the floor level on a 1-minute chart in order to trade short. Once again, all these levels on every single chart are already laid out in advance, so there's no surprises. Let's talk about that for a minute. No surprises. A true professional knows very well that he or she, and I know Diane Harville's in the room here today because I can see her name, that in any endeavor in life, all things need to be planned out first. In this case, in the trading environment, it is so much more important than any other type of business. We need to be fully prepared for anything that could possibly happen, known as redundancy, so that if and when it does, there is no surprises. Because when there are surprises, traders, it affects your emotions. When emotions get affected, then things change rapidly, right? And we know that when they change, they're not going to change in our favor. They're going to change in the favor of the largest participants that are going to want to take that money from us. Therefore, this methodology was specifically designed to be able to run what-if scenarios so that no matter whatever happens, we're fully prepared ahead of time. No surprises mean maintaining focus in the moment, maintaining focus to the task at hand, managing the trade to the downside so that we gain a profit when the opportunity presents itself. This is the way of a true professional. So let's make note of this. If you have a pen at 21.0875, the 15-minute support level, knowing that the 15-minute level is the approximated level for the 1-minute chart, let's get into the 1-minute chart here for a minute and take a good look at what I was looking at the moment that I was looking at it. ES1, near contract month, 6/2015, 1-minute chart. Now, the 15-minute chart obviously had a level that was a little bit higher than the 1-minute chart itself. In this case, the 1-minute chart rules because it is the exact floor level based on the faster time frame, which actually created the 15-minute chart, which created the daily chart that actually needs to get through. So thinking in reverse from the daily to the 15 to the 1 minute, now we're focusing in on the 1 minute chart because this is the fastest time frame that we're looking at the moment that will decide whether or not we will trade short in this morning's session or not. This 2108.25, a half a point below the 2108.75 15-minute level, was dictated by exactly this bar located at 3:27 a.m. That's 03:27 hours and 4/29/2015. That closing price is 2108 right here, 2108 and 50. So therefore, 2108.25 at this point would be the support level and getting through by a quarter of a point in order to be short. Now, looking at this level for the preferred in would be the opportunity to get in here and then ride the trade down, which is obviously lower than the 15-minute level. So here's the guarantee that now we're in after the 15-minute level has been crossed, after the 15-minute level has been crossed, and again the 1 minute level as well. Going back, 2108.25 here, 2108.50. Now look at 2107.75 that was laid out by this price right here, the juncture of 1, 2, 3, 4 different data points. That's again 1, 2, 3, and 4 different data points right here. So if prices were going to fall, this is the likely area where they should get to first, possibly move sideways, and then down to here, and then maybe down to here, and possibly even the mean of all the prices here, which I had set. Now this is under the pretense that if you have a strong sell-off with enough volume, people, that prices should continue to move to the downside to get to a major support area or close to it, right? In any one of a number of legs. The less, the better. The best possible trade setup to be followed through with and taken advantage of should always be the first leg. That first leg was realized right here, getting through the floor to get the fill and getting out right here at 2106 and 75, right? A possible second trade could have been had after the new floor was established here by the prices at the price profit target at 2106.75, right? After the volatility washed away itself between these two levels to get in again a tick below right here. So in between here and here, there's nothing. This is where the volume came in, prices halt, move up, turn back around, volatility increases. And the second opportunity should not have been until at least through the most very recent floor right here by a tick or possibly even one tick lower right here and nothing more for the best possible fill right here on a limit order at 2105 and 50. There's the second leg right there, people. And the 15-minute indicators had to be positive to the downside on the second leg in order to take this trade short. This trade, getting in just below 2106 at 2105 and 75 right here, wrote it down right to the daily level that was laid out at 2103 and 75 to get out on a target right there before all the volatility came into play and changed everything and any decision whatsoever for the possibilities of taking another leg to the downside, even though the prices moved very quickly again for another leg. What changed everything once again, if you look at the chart pattern here, very well organized, low range bars. Very well organized, lower range bars. And here, much higher range at this point, especially the last 3 bars before the final leg could have been taken. Best possible trade, secondary best possible trade to guarantee the highest profit possible. So out of all this, and even getting in late here on a bad fill myself, getting out today, the early morning session for 2.75 points times $50 for every full point move, trading 20 contracts brought me $2,750 today. Now the contract sizing obviously changes based on the risk tolerance of the individual trader. But the actual points gain times the gain per contract, every full point move being $50, every quarter of a point move being $12.50 is always static. That will never change. This is exactly how a professional views it and should trade it in order to gain or extract, I want to say, the maximum amount of money on a great setup where the money was basically there waiting to be had. A lot of traders may have traded the third leg here, but after the volatility came in, the more the move gets overextended to the downside, the more the 15-minute indicators get overextended to the downside as well. And the lesser degree of a real high probability trade setup that exists is evident, becomes evident. And therefore, the increase in risk is just, for me, it is not worth the stretch. I'll take the guarantee on the first and second leg. If we have a major market sell-off where there's an opportunity to take the extended hold time on a trade, okay. But that is not the case yet. We have no major volume spike on the end of day charts as of yet to factor in the possibilities that the smart money has made a major sell-off, usually on market close orders, right? That's not evident yet. Not as of today's analysis. I'll reload the charts and see if that changes on tonight's end of day analysis for tomorrow's trading. But right now, that hasn't been loaded, and this is exactly where we stand based on the analysis so far. Can I get a raise of hands of everyone in the room who clearly understands what I have laid out? Charles, Diane, Mark, Nicholas, Judy, Warren. Arthur. We have a lot of traders in here with a lot of water under the bridge. I know. And I really do appreciate the comments because there's a lot of work involved in this. There's a lot of planning. It takes a long time to set everything up in order to trade. In many cases, an hour's worth of work before anything can be considered for trading for the session. And it's very precise. So the presentations, I believe, reflect that substantial work that's involved in doing all this. Now, on any given trading day, there may or may not be possibilities, the same as we saw today. The market is poised for a larger sell-off. There's no doubt about that. Whether that will happen or not depends on the intraday volume added up at the end of it all, especially market on close volume, that once again will be reflected on the end of day charts, right? And the subsequent confirmations that come through on the MFI and the CMF with more momentum to the downside, right? Leading the way of the future direction of prices in real time that will provide us with, once again, a series of trades to the downside, but only and only when we have the right type of setup. I have written many articles that have been published in many magazines, done many webinars, many trading expos, and the theme is pretty much always the same. It's a centralized belief that your greatest positional advantage as an independent trader is patience and waiting for the trades to come to you, to prove to you that they're worthy of your time and your money and your emotional capital. Now, everything about this particular methodology is extremely well thought out, from the black background to be able to view the charts for 8, 10, 15 hours at a time without getting tired. to the painstaking work that's put into the price levels, to the indicator confirmations or non-confirmations in considering trading, whether short or long. In today's session, short, right? And understanding that if there isn't the right type of setup, you have to do nothing. You cannot invent and trade, people. You have to be on the sidelines up and until and when the trade comes to you. If not, if you chase the trade, you're going to be giving back money in a short period of time. This is not what we want. We want to follow the rules. We want to follow the trading plan and be very strict about it, because there can always be another trading opportunity, and there always will be. But there will not always be more money in order to trade those trades when they come if you vary from the centralized idea put into practice that your greatest positional advantage as an independent professional is patience, waiting for the trades to come to you. So one more time, I wanted to hammer that home. So I hope that today's webinar has been something out of the ordinary, something that you can take and use, implement into your trading tomorrow, tonight, to become a more profitable trader. This is not easy. Anybody who says so is not in the arena of a profitable trader. It takes a lot of work, it takes a lot of dedication, it takes a lot of focus, it takes a lot of backbone. But there is no other business in the world today that I'm aware of that with a small amount of capital, getting yourself educating, empowering yourself, getting the right information, and putting your time and grade in can pay off the way that this can. Jeff Killian, the Chief Market Strategist for the Inside Technician. Once again, welcome to the Traders Alliance weekly webinar, all of you, and everything that we can gain from it. Trading is an isolated business. Here, we're united to work together to become the best that we possibly can. We'll see you next week on the next week webinar. And until then, all the best to all your success and all of your trading. Good night.